Silver is disappearing, not from the periodic table, not from the Earth's crust, but from the vaults, the warehouses, and the stockpiles that the world depends on to keep the lights on, the cars running, and the technology functioning. For 4 consecutive years, humanity has consumed more silver than it has mined. 4 years of deficits, 4 years of drawing down inventories that took decades to build, and almost nobody is paying attention. By the time the story makes mainstream headlines, it will be too late to act on it. The vaults will be empty, the premiums will be through the roof, and everyone will pretend they saw it coming. But you're watching this now, which means you have information that 99% of the population doesn't have. What you do with that information is up to you. Before we dive in, if you're new here, this channel breaks down how money really works. Not the version they teach in school, the real version. Subscribe and turn on notifications because understanding what's happening to silver could be one of the most important financial insights of this decade. Let me show you the math that's keeping mining executives up at night. Silver is not just a precious metal. It's not just something people buy for jewelry or investment. Silver is the most versatile industrial metal on the planet. It's the most electrically conductive element on the periodic table. More conductive than copper, more conductive than gold. When you need electricity to flow with zero resistance, you use silver. It's the most thermally conductive metal. When you need to move heat efficiently, you use silver. It's the most reflective metal. And when you need to capture or redirect light, you use silver. These aren't marketing claims. These are the laws of physics, and physics doesn't negotiate. Because of these unique properties, silver has become absolutely essential to the technologies that are reshaping our world. And the demand is exploding in ways that most people don't understand. Let's start with solar panels. Every solar panel ever made contains silver. The electrical contacts that capture the sun's energy and convert it to electricity are made with silver paste. There is no substitute that works as efficiently. Scientists have tried. Engineers have tried. Nothing matches silver's conductivity. In 2020, the solar industry consumed about 100 million ounces of silver. That sounds like a lot, but watch what happens next. In 2024, solar consumed over 200 million ounces. That's a 100% increase in 4 years. By 2030, conservative industry estimates suggest solar will consume over 300 million ounces per year. Some analysts project 400 million. Now here's the critical context. The entire world only mines about 820 million ounces of silver per year, total, from every mine on the planet. Solar alone could consume 40 to 50% of global mine supply within 5 years. 1. Industry. 1 application. Half of all the silver we dig out of the ground. And solar is just getting started. The world is racing toward renewable energy. China is installing solar at a record pace. Europe is mandating it. America is subsidizing it. India is building massive solar farms. The trajectory is only going up. Now let's add electric vehicles. The average electric vehicle contains about 1 ounce of silver. That doesn't sound like much until you look at the production numbers. In 2024, the world produced about 14 million electric vehicles. That's 14 million ounces of silver demand that barely existed a decade ago. By 2030, projections suggest global EV production will hit 70 million vehicles per year. That's 70 million ounces of silver every single year, just for cars. And it's not just the vehicles themselves. The charging infrastructure requires silver. The power grid upgrades to support EVs require silver. The batteries and electronics and sensors all require silver. The entire electric vehicle ecosystem is a massive silver sink. And we're just at the beginning of the transition. Now let's add electronics. Every smartphone contains silver. Every laptop, every tablet, every desktop computer, every server and every data center that powers the internet processes your emails, stores your photos, and runs artificial intelligence. Speaking of artificial intelligence, the AI revolution is creating unprecedented demand for computing power. New data centers are being built at a furious pace, each one packed with thousands of servers, each server containing silver. The explosion in AI applications, from ChatGPT to image generation to autonomous systems, is driving a surge in silver demand that wasn't even in forecasts 3 years ago. Now let's add medicine. Silver has natural antibacterial properties. It kills bacteria, viruses, and fungi on contact. This makes it invaluable for medical applications. Silver is used in wound dressings, surgical instruments, catheters, and medical implants. Hospitals use silver-coated equipment to prevent infections. As healthcare spending grows globally, medical silver demand grows with it. Now let's add traditional photography, brazing and soldering, mirrors and coatings, water purification, and dozens of other industrial applications that each consume millions of ounces per year. Add it all up and you get a picture of demand that is not just growing, it's exploding. In 2024, total global silver demand exceeded 1.2 billion ounces. Let me say that number again, 1.2 billion ounces. Now let's look at supply. Global silver mine production in 2024 was approximately 820 million ounces. That number has been essentially flat for a decade. It hasn't grown meaningfully since 2016. 1.2 billion ounces of demand, 820 million ounces of mine supply. Even a child can do this math. Demand exceeds supply by nearly 400 million ounces every single year. So where does the extra silver come from? It comes from existing stockpiles, inventories that were built up over decades, vaults full of silver bars that were accumulated when demand was lower and supply was higher. For 4 consecutive years, the world has been drawing down these stockpiles to meet demand. We've been living beyond our means, silverly speaking. And those stockpiles are getting thin. The COMEX is the primary futures exchange for silver in the United States. It maintains warehouses full of silver that back the paper contracts traded on the exchange. In 2021, COMEX held over 400 million ounces of silver in its registered and eligible vaults. That seemed like a comfortable cushion. Today, that number has dropped to around 150 million ounces, a decline of over 65% in just 4 years. Let me put that in perspective. At the current rate of drawdown, COMEX vaults could be effectively empty within 2 to 3 years. And COMEX isn't alone. The London Bullion Market Association, which tracks silver inventories in London vaults, has reported similar declines. Silver is leaving Western vaults at an alarming rate. Where is it going? A lot of it is going east. India imported over 300 million ounces of silver in 2024. That's the highest number ever recorded in history. Indian demand for physical silver has exploded as their economy grows, and their citizens seek to protect wealth outside the banking system. China doesn't publish accurate silver import data, but satellite imagery of shipping ports, customs records from trading partners, and analysis of Shanghai Gold Exchange flows all suggest China is accumulating massive quantities of silver. This isn't just investment demand. Chinese solar panel manufacturers need silver for production. Chinese electronics factories need silver for components. Chinese EV makers need silver for vehicles. The world's manufacturing powerhouse is securing the raw materials it needs. And silver is at the top of the list. So we have a situation where demand is exploding, supply is flat, and inventories are draining. This is the setup for a supply crisis. But here's what makes this different from other commodities. When copper gets expensive, you can substitute aluminum in many applications. When oil gets expensive, people drive less or switch to alternatives. Most commodities have substitutes or demand destruction mechanisms that balance the market. Silver is different. In electronics, there's no substitute that matches silver's conductivity. In solar panels, alternatives are less efficient and more expensive. In medicine, silver's antibacterial properties are unique. For most of silver's critical applications, there is no plan B. Manufacturers need silver, period. And unlike other commodities, silver supply cannot respond quickly to higher prices. It takes 7 to 10 years to discover, permit, and build a new silver mine. Even if prices doubled tomorrow, meaningful new supply wouldn't arrive until the mid-2030s. Most silver is mined as a byproduct of copper, lead, and zinc mining. Only about 30% comes from primary silver mines. This means silver supply is largely dependent on the economics of other metals, not silver itself. Mining companies spent the last decade underinvesting in exploration and development because silver prices were too low to justify the capital expenditure. That underinvestment is now coming home to roost. We're heading into a supply crunch with no ability to quickly increase production. This is the situation that almost nobody is talking about. The mainstream financial media is focused on interest rates and stock prices and the latest political drama. Silver barely gets a mention. But in the physical market, the stress is showing. Premiums on physical silver coins and bars have remained elevated since 2020. When paper prices and physical prices diverge, it's a sign that the paper market is not reflecting real-world supply and demand. Mints have reported periodic shortages. Dealers have reported delivery delays. The physical market is tighter than the paper price suggests. And yet, silver trades at $64, still 66% below its inflation-adjusted 1980 high. Still trading at a 41-to-1 ratio against gold when the historical average is 15-to-1. The market is not pricing in what's coming. In part 2, I'm going to show you why this disconnect exists, who benefits from keeping silver prices low, what has to happen for prices to reflect reality, and what the world looks like when a critical industrial metal becomes genuinely scarce. The math says we're running out of silver. The only question is what happens when the world finally notices. In part 1, I showed you the math that proves the world is running out of silver. Demand at 1.2 billion ounces, supply at 820 million, 4 consecutive years of deficits. COMEX inventories down 65%. India and China draining Western vaults at record pace. The numbers are clear. The trajectory is obvious. And yet, silver trades at $64, while every other major asset hits all-time highs. Why? How can a market be so blind to such obvious fundamentals? The answer is that the silver market isn't blind. It's structured. And understanding that structure is the key to understanding why silver is still cheap and what will eventually break the system. Let me explain how silver prices are actually set. Most people assume that supply and demand determine price. More buyers than sellers, price goes up. More sellers than buyers, price goes down. Basic economics. In the silver market, that's not quite how it works. The price of silver is primarily determined on the COMEX futures exchange. Futures are contracts to buy or sell silver at a future date. Most of these contracts are never settled with physical delivery. They're cash settled or rolled over into new contracts. This creates a situation where the paper market is vastly larger than the physical market. On any given day, the COMEX trades the equivalent of 300 ounces of paper silver for every 1 ounce of physical silver in their vaults. 300 to 1. That's not an exaggeration. That's the actual ratio. When a large institution wants to push the price down, they can sell massive amounts of paper contracts. Right? These aren't sales of physical silver. They're sales of promises, and there's no limit to how many promises you can sell. This selling pressure from paper contracts pushes the price down, even when physical demand is strong. Is this manipulation? In 2020, JP Morgan Chase paid $920 million to settle charges that they manipulated precious metals markets. They admitted to placing hundreds of thousands of fake orders over 8 years to move prices in their favor. This isn't conspiracy theory, it's documented fact. They paid nearly $1 billion in fines and admitted guilt. JP Morgan wasn't alone. Other banks have paid similar fines. The manipulation of precious metals markets is one of the most prosecuted financial crimes of the last decade. So why does it continue? Because the incentives are enormous. Banks hold large short positions in silver futures. When prices fall, they profit. When prices rise, they lose. More importantly, silver and gold are competitors to the paper money system. If people lose faith in dollars and rush to precious metals, it threatens the entire financial infrastructure that banks depend on. Keeping silver and gold prices low maintains confidence in paper currencies. It's not just about trading profits. It's about preserving the system. This is why silver has been suppressed for over 4 decades. Since the Hunt brothers tried to corner the market in 1980 and the exchanges changed the rules to stop them, the paper market has dominated price discovery. But there's a problem with this system. It only works as long as there's enough physical silver to maintain the illusion. When paper promises meet physical reality, something has to break. And we're approaching that breaking point faster than most people realize. Remember those COMEX inventory numbers, down 65% in 4 years. From over 400 million ounces to around 150 million. At some point, there won't be enough physical silver in the vaults to meet delivery demands. When that happens, the paper price becomes meaningless. What matters is what someone will pay for real metal. We've seen previews of this. In March 2020, when the pandemic hit, physical silver premiums exploded while the paper price crashed. Dealers were selling coins at $10 to $15 over spot. People couldn't get physical silver at any price close to the paper market. That divergence was a warning shot. The paper market said silver was worth $12. The physical market said try 25 or 30 if you can find it. That gap eventually closed as the crisis passed. But the underlying dynamics that caused it haven't changed. They've intensified. More demand, less supply, thinner inventories, higher deficit. The next time paper and physical diverge, it may not close so easily. So what happens when the world actually runs out of silver? Let me be precise about what running out means. The earth still has silver in the ground. Mines will still produce. Running out doesn't mean zero silver exists. Running out means there's not enough readily available silver to meet demand at current prices. It means manufacturers compete for scarce supply. It means prices must rise to ration demand and incentivize new production. In commodity markets, this is called a supply squeeze, and they can be violent. In 2022, nickel prices doubled in a single day when a supply squeeze hit the London Metal Exchange. The exchange had to halt trading and cancel billions of dollars in transactions because the paper market broke. In 2021, lumber prices went up 400% in months when supply chain disruptions met strong housing demand. In 1980, silver went from $6 to $50 in about a year when the Hunt brothers' buying met limited supply. When supply squeezes hit, prices don't rise gradually, they explode. They gap up overnight. They make moves that seem impossible until they happen. Silver has all the ingredients for a historic supply squeeze: structural deficit, depleting inventories, Inelastic demand from industries that have no substitutes, constrained supply that can't respond for years, and a paper market that has suppressed prices far below physical reality. The only question is timing. When does the paper game break? Nobody can predict the exact moment, but we can identify the triggers. Trigger 1 is inventory depletion. When comics registered inventory drops below a critical threshold, large traders will demand physical delivery rather than cash settlement. This forces the exchange to actually produce metal it may not have. Trigger 2 is industrial panic buying. When a major manufacturer like a solar panel company or electronics firm realizes silver supply is genuinely threatened, they'll start stockpiling. They'll pay whatever it takes to secure supply because shutting down production is not an option. Trigger 3 is investment surge. If economic instability drives a rush into precious metals, the tiny silver market could be overwhelmed. Silver's market cap is less than $100 billion. That's smaller than many individual tech companies. A small percentage of global investment flows moving into silver would exhaust available supply. Trigger 4 is currency crisis. If confidence in major currencies falters, if inflation spikes again, if debt crises spread, precious metals become a safe haven. Gold is already at all-time highs. Silver typically follows and outperforms gold in bull markets. Any one of these triggers could break the paper suppression. Multiple triggers occurring together could create a price move that makes 1980 look tame. So where could silver prices go? Let's look at 3 scenarios based on simple math. Scenario 1 is the inflation adjustment. Silver hit $50, in 1980. Adjusted for inflation, that's $190 today. If silver simply returns to that level in real terms, it's a 3x from current prices. Scenario 2 is the gold ratio reversion. The gold to silver ratio is currently 41:1. The historical average is 15:1. If that ratio normalizes with gold at $2,600, silver reaches $177. Again, roughly a 3x. Scenario 3 is the supply squeeze premium. In a genuine shortage, prices can overshoot fair value dramatically. Nickel went up 100% in one day. Lumber went up 400% in months. A silver squeeze could send prices to 300, 400, or higher before stabilizing. I'm not predicting specific prices. I'm showing you the math of what's possible based on historical precedent and current fundamentals. At $64, silver is priced as if supply is unlimited and demand is stable. Neither is true. So what does this mean for you? First, understand that this is not financial advice. I'm not telling you to buy silver. I'm presenting data and analysis that you should verify independently and discuss with qualified professionals before making any decisions. But I will tell you what I find interesting about this situation. Silver at $64 is one of the few assets that is not at all-time highs. Everything else, stocks, real estate, gold, Bitcoin, has already run. Silver is still 66% below its inflation-adjusted 1980 high. Silver at $64 is pricing in none of the supply crisis we've discussed. The market is acting as if deficits don't matter, as if inventories aren't draining, as if demand isn't exploding. Silver at $64 is still affordable for regular people. You don't need $50,000 for a down payment like real estate. You don't need $2,600 per ounce like gold. Anyone can buy a few ounces of silver, and silver is essential to the technologies that the world has decided are the future. Solar, electric vehicles, electronics, AI infrastructure. These aren't optional industries. They're national priorities for every major economy. The world has committed to these technologies. The world has not committed to producing enough silver to build them. Something has to give. Either demand slows dramatically, which would require abandoning the clean energy transition that every government has endorsed, or supply increases dramatically, which is physically impossible for at least a decade, or prices rise to balance the market. The math points to option 3. I started this video by saying that silver is disappearing, that the world is running out, and that almost nobody is talking about it. By now, you understand what I mean. The annual deficits, the draining inventories, the explosive demand from technologies that define our future, the supply that cannot respond. This is one of the most obvious supply-demand imbalances in any commodity market. And it's happening in plain sight. The mainstream financial media won't cover this story until it's too late. They didn't warn about the housing bubble in 2008. They didn't warn about inflation in 2021. They won't warn about silver until prices have already moved. But you've seen the data now. You understand the math. You know what's coming before it becomes headline news. What you do with that knowledge is up to you. If this video helped you understand what's happening in the silver market, share it with someone who needs to see these numbers. Subscribe if you want to keep learning about the financial realities they don't teach in school. And ask yourself this question. If the world is consuming 400 million more ounces of silver per year than it produces, and inventories are down 65% in 4 years, and there's no new supply coming for a decade, then what happens next? The math has already answered that question. The market just hasn't caught up yet. I'll see you in the next one.